Welcome to the annual Property and Funds Virtual Investor Showcase. My name is Steve Torso and I'm the Managing Director and co-founder of Wholesale Investor. Especially now, the why behind this event is important. Over the last 12 months, global markets have experienced unprecedented amounts of stimulus from governments. This stimulus has supported economies, and now, as markets are recovering around the world, inflation is a concern amongst investors. Fixed asset and yield opportunities have become of high interest to high net worth and professional investors, along with backing proven fund managers. Wholesale Investor ourselves, over the last 12 months, we are super proud to note that 3 of the top performing fund managers in the country all featured at Emergence 2020. That's Apollo Capital, Digital X, and Terra Natural Resources Fund. We have a proud tradition of finding unique and exciting opportunities long before general markets are aware. Today, as presenting companies, we have Versailles Capital, Capital Prudential, EG Private Wealth, Parker Winston Eckhart, and Unhedged. Both have actually got unique algorithmic trading funds, MaketoRent, My Property Solutions, and Crowd Property. As a keynote speaker, today we are very excited to actually bring you Steven Bennett, who's Direct CEO at Charter Hall. You'll also hear from a unique panel session where it's talking about property investment and development in a post-pandemic environment. Our panelists include Jerome Lander, CIO at Wealthlander, Darren Younger, CEO of Bricklets, Troy Harper, Director at Aviator Capital, Ron Shemgar, Head of Australian Equities at Tamim Asset Management, and Rod Hay, Head of Distribution Investor Relations at Collins Street Asset Management. We know how important it is to have a simplified and streamlined process for you so that you can access the opportunities which are presenting today. Now, we do this by connecting you with the opportunities on our CRIISP platform. So on the actual stream page that you're viewing this, I recommend click on CRIISP, create an account. It only takes a couple seconds to do it. If you already have an account, keep the actual platform open. And then as each company is presenting, you can click on the link directly with that company, access the opportunity, and then go into Q&A with the companies that are actually presenting. So today, we have an exciting session for our annual Property and Funds Virtual Showcase. I look forward to having you participate. I welcome you to the event. Enjoy the showcase.
Our keynote speaker today is Steven Bennett, Direct CEO at Charter Hall. Steven will be covering the topics such as insights emerging through the pandemic, as well as the medium and long-term trends in the Australian real estate sector.
Hello and welcome to the Property and Fund Investor Showcase. My name is Steve Bennett and I'm the Direct CEO at Charter Hall. I'm really pleased to be given the opportunity today because the last 12 months has been a very interesting period. And hopefully through today's presentation, I can share some of the insights that we've seen in managing through the pandemic, some of the medium to longer term trends which we expect to occur in the Australian real estate sector, as well as give you a bit of an overview of where we see the core sectors of office, industrial logistics, and retail going. But before I get into that, a little bit more about myself. I've got a couple of decades actually of experience in the property funds management industry. My team look after a little over $8 billion of gross assets in Australian commercial property spread across those core sectors, which I just mentioned. And we tend to focus on high net wealth clients, self-managed super fund, as well as direct investors. I sit on a number of committees of the Property Council of Australia and Property Funds Association. And ultimately, I believe that the experience I get day to day will give me a great opportunity to give you a bit of a summarization on some of those key aspects which we've talked about. As I always do with this, it is very important to understand that everything I'm about to say is just general advice. In fact, the only objective we have here is to provide education. None of it relates to your individual circumstances. And if at any time you do think about investing with Charter Hall or any fund manager for that matter, always do read the product disclosure statement. So who are Charter Hall? Well, I tend to think we're very well known, but we tend to be very well known within the property sector. In fact, we're the largest manager in the country of third-party capital invested into commercial property. The reason why I mention that isn't to promote how big we are, but it's to highlight some of the advantages that scale brings in property. It means you have deep relationships with your tenant customers, often across different sectors. So a great example is we may have Coles, we've got their office building in Toorak, Melbourne, their industrial and logistics assets in Adelaide and Perth, as well as covering all the neighbourhood shopping centres. You can see there we've had some terrific growth over the last 5 years, compounding at an average per annum rate of 24%. So we do have that exposure to all the key tenants, all the key sectors, and we've been very well placed during the pandemic because of the type of assets which we manage. But I'll come to that more as we go through today's presentation. So the first part is, well, what are the trends which we're seeing? Some of these will be obvious. Some of these we'll dig into in a little bit more detail. Well, e-commerce continues to accelerate. That's no real surprise. We're now in a world where, for the first time, some people have ordered online, which hadn't previously been done. What that's meant is that it's driving the demand for industrial logistics assets to serve those e-commerce orders. Because every time someone clicks a button or places that order, there's a whole bunch of processes that kick on. We're seeing negative impacts on discretionary retail. And I'll touch on this later as well, but not all retail property is the same. We tend to bucket it at Charter Hall within discretionary and non-discretionary. So the benefits for e-commerce, you need to flip it around. They're actually a headwind to those large fortress malls and that discretionary retail where people are now ordering more and more those products online. You are seeing increased flexibility and an increased take-up of work for home. So I'll touch on what does that mean for the office sector in the medium to longer term. And you're seeing very hot assets such as healthcare and Bunnings continue to be in strong demand by investors, whether they're syndicators, the big end of town, institutional managers, or private investors. There's a large demand for these type of assets. And finally, in terms of the trends, I would say, one of the reasons why Charter Hall came through the last 12 months of immense volatility so well was because we focus on that prime end of the market. And that's just a fancy way of saying the highest quality real estate. We like long-term leases, that we have the highest quality tenants as well. So think governments, ASX top 20. These are all companies and entities that went through the pandemic without skipping a beat. And this next slide is a great visual way to see the e-commerce impact. And what you'll see there is the grey section is basically a pull forward of what most market commentators thought was going to be 5 years worth of e-commerce growth, all happening in a very short period of time. So you can see there that small yellow line, that's where we're at now in terms of the percentage of retail sales that are driven through e-commerce channels. And we expect that that trend will continue to accelerate. Importantly, when you look at this statistic on a global nature, Australia is still very much lagging other major economies in the world, such as China, UK, and the US in terms of e-commerce penetration. And so what were some of the things that served us well and what worked in managing almost a $50 billion portfolio of assets through the first pandemic we've had in 100 years? Well, the first is you need to be agile. You need to be transparent, and that transparency needs to cut across not just your investor customers, but to also your tenants. A key example of what we did in this space was we moved very quickly to do out-of-cycle independent valuations, and we increased the level of communication we provided to our investors. We also held the hands of many of our tenants in helping them get back into the office. So you needed that tenant focus side and realized that everyone was going through a scenario where they hadn't been through before. So us being able to provide our expertise and help our tenants safely and efficiently get back into their office towers, their industrial and logistics buildings, and the retail centers was something that they really valued. We maintained a very risk-focused approach. For example, we drew down all our lines of debt facility. As it turns out, it wasn't needed, and the banking sector remained open and able to lend money throughout the pandemic, but it was something that we thought was prudent to make sure that the funds were protected at all time. It reinforced that real estate is really a relationship business. So the relationships with your tenants, but also relationships with key service providers, consultants, sales and leasing agents, tenants through sale and leasebacks. And we had a real benefit because we have teams located on the ground where our assets are located. So whether it's an office building in Brisbane, an industrial property in Adelaide, or a retail centre in Perth, we have people on the ground that were there to work with our tenants, do leasing negotiations, and help them through that period. It was even more important in a time when borders were opening and closing. And as I sit here now, there's been a recent outbreak in Victoria, which has temporarily shut the borders and limited that interstate travel. So you can imagine how hard it would be to manage these assets if we're all Sydney-based and not located where the assets are. The active portfolio management, that simply means that you continue to work with your tenants and you don't just sit back. Through the pandemic, 3 of our 4 funds actually increased their average weighted lease term. And we did that by helping our tenants as well. So I'll give you an example. Some tenants needed some rental relief or some holidays because they were shut and effectively locked out of their premises. So what we did was we worked with them, helped them on the immediate cash flow problems they may have had. And in exchange, we extended the lease terms out, meaning that our investor customers ultimately ended up with a longer, more secure income stream. And finally, the returns and volatility. We're very pleased to see that unlisted property came through very strongly. Whilst the listed markets had a savage sell-off and then a savage rebound, unlisted property didn't skip a beat. It tended to track along. And when I talk to the sectors, I'll give you a little bit more insight on what we're seeing around the valuations of some of the key sectors and what differentiates the best performing assets in those sectors for the ones that are struggling. And ultimately, it was borne out in our returns. So just up there on the screen, 5 blue lines represent the funds that are open for investment in the business that I look after, the direct space, and the grey bar being the benchmark returns. You can see here all very healthy returns, and this is since inception to 31 March. It doesn't actually reflect the valuations which will be getting booked at 30 June. And because these funds are open, I can't give you any clarity on those. But what I would say is the listed REIT sector, the valuations that they've announced tended to have been quite positive for different sectors and for assets that had long-term leases underpinned by strong tenants and that were in great locations. And that's a trend we expect will continue throughout our portfolio as well. So this brings me to the first of the specific sectors I'll cover, industrial and logistics. Well, for those that are in property, you'll already know that this is the hottest part of the market at the moment. To give you an idea of just how in demand it is, a $3.8 billion industrial portfolio came to market and was recently transacted. It's the largest individual property sale in this country ever. And there was more than 10 underbidders, so 10 groups, in excess of 10 groups who missed out. So there was in excess of $40 billion of capital chasing that portfolio, which didn't ultimately get set in the space. Why are we seeing this demand? Well, we've seen it for a number of reasons. I already mentioned the e-commerce and how that's driving the tenant demand, so greater demand for the warehouses and these logistics facilities, but also the investment demand. So there's 3 trends as well. So the tenant side around e-commerce, the investment side, where some of the largest investors in real estate on a global sense are trying to upweight to the industrial and logistics sector. They're doing this because they believe the tailwinds are very strong and that this growth that the sector's seen has many more years to play out. And finally, you're also seeing a trend around onshoring. What the global pandemic showed was that countries need to have self-reliance in certain key sectors. So whether that's in food, pharmaceuticals, PPE, being able to generate the medicines and the vaccines, what that's done is it's meant that previously where you may have a facility offshore and you may have a very low stock or inventory, companies and governments are now saying, hang on a minute, we need to do that in this country, and it's creating further demand for industrial and logistics. The biggest challenge in this sector at the moment is getting quality stock. In any property sector, when it's booming, what you tend to find is the prime. Remember, prime is the highest quality assets, And the secondary, the pricing tends to converge. And that's because people and buyers, in their eagerness to get set, suddenly stop being as discerning around the quality of the assets. Where's the location? How strong's the tenant? Have the assets been maintained? So what we're doing at Charter Hall is we're doing more sale and leasebacks than we ever have before. We've actually done over $10 billion of sale and leasebacks in the last 5 years. We've got very strong relationships with sellers, tenants, as well as agents, meaning we've been able to buy assets off market as well. So whilst this is a very strong sector, I do just always encourage people to make sure you do your due diligence, and partnering up with a manager who can actually get access to the best quality stock without overpaying for those assets is critically important. What I'll next show you is a very short 20 or so second video with the trends that are happening in industrial. So you'll see here up on the screen, a whole bunch of little robots whizzing around. This is a partnership we've done recently with Coles, who have teamed up with a group called Ocado. These little robots zip around on a hive type structure. And typically you'll have over 800 of these robots in the center, fulfilling over 80,000 online orders a week. So this is something at Charter Hall we want to stay at the forefront of. We want to understand, and we will continue to work with our tenant customers, because this is where some of the real top end, high end industrial logistics is going. The next sector, office. This is a sector that I get asked a lot of questions on at the moment. And the largest question I get is around working from home. We don't subscribe at Charter Hall that the office is dead, as some naysayers put out there. We firmly believe that the office is a place for collaboration, getting people together, for driving high performance cultures, as well as basic things like risk management, having people knowing what's going on. So whilst we do believe there will be greater flexibility around where people work and how often they do come into the office, we're less certain it's going to have the big impact on demand that some people think. There's been numerous studies put out, and the most days people want to work from home are, not surprisingly, Monday and Friday, with the offices still at full capacity on Tuesday, Wednesday, Thursday. So what does that mean? Well, at Charter Hall, how do we take less space if we still have most of the team in on those days? And in fact, at Charter Hall, the only thing limiting us getting everyone back at the moment is because the densities, so how many people we had on the floor pre-pandemic, are not allowed in a post-pandemic world. So you've had to separate people, you have had to have less people in meeting rooms. So on any given day, we can only utilize 65% of the space to get our people back in. So that's something which we hope will change as vaccines come, but that is also something that's pushing back against the work from home trend. Interestingly, I just highlight that around 62% of the office sales that were made in the last 12 months, so calendar year 2020, were to some of the most sophisticated global buyers. So 62%, in fact, were to offshore capital. These are sovereign wealth funds, pension funds, private equity funds. And why are they buying Australian office assets? And typically they buy in the Sydney and Melbourne gateway cities. Well, this slide up here on the screen shows the yield spread. That's just a fancy way of saying what's the gap between long-term interest rates as well as the yield which you can get on prime office assets. And you can see here the brownish color shows that the gap between the cost of debt and the returns you can get on property in this country are elevated and much more favorable than other gateway cities such as Paris, Tokyo, and Hong Kong. So these global investors are looking at Sydney and Melbourne office, and on a relative sense are saying it's very attractive, and that's why they're voting with their feet and buying these assets. But what are they buying? Well, they're very much focused on the prime assets, so newer assets. Anything with long-term leases in place is selling well. And finally, what I would say there is the valuations reflect that. So those long leased assets at the top end are selling at prices in excess of the book value. But the shorter end, where the leases are very short, they may have some vacancy, or the location is off pitch, they're the office assets which are coming under valuation pressure. This next chart really just shows you the spread on a historical 20-year basis is the line, and the X is the 10-year average, and the little blue triangle you can see there is where we sit now. So what this is showing that on a long-term basis, the spread between office property and the cost of debt is elevated. So this would tend to, in most markets, give an indication that there's a potential for cap rate compression, meaning prices could go higher over the medium to longer term. But as I said, you do need to, like industrial, be very discerning and make sure you're targeting the right quality office assets. And finally, to round out the sectors, the retail sector. So the first thing is, do not assume all retail is the same. So we bucket it, retail being supermarket retail, something that was very resilient through the pandemic. These assets are trading very well. They're in strong demand from private investors as well as institutions. And at the other end of the spectrum, you have the discretionary malls. They used to be known as fortress malls because they were thought as impenetrable, that they would always preserve value. Whereas in fact, what the pandemic has done has sped up the trend that was already underway around e-commerce and those big malls struggling to maintain the rent levels which they had. In fact, of all the commercial property sectors, it's those big discretionary malls which came off valuations most. So you actually had industrial and logistics accelerate in terms of valuations. Long leased office assets continue to go up, but at a more moderate pace. And the retail sector was no different. You had that diversification where the neighborhood centers, the Coles, the Woolies, the Aldi anchored shopping centers, typically with half a dozen specialty stores, have performed very well and have been bid very strongly in the market. And then at the other end, I wouldn't say you've got a buyer's strike, it's too strong a word, but the level of demand for those large regional malls has definitely declined. And we expect that to continue at least for the short to medium term until the floor in the pricing is reached. When that is, no one knows for sure, but at some point, those rent levels will settle at a level where the valuations stop moving and in fact start to turn around. Look, that was a very quick around the traps on the impacts of the pandemic, key trends, and I've also gone through the various sectors. Up there on the screen, I would just highlight a few of our open funds. If you're potentially interested, but please, as I said at the start, always do read the offer documents if it's something you're looking at. And so to wrap it up, the key trends around e-commerce, the demand for industrial and logistics are not going away in our view. The working from home will have a negative impact, at least on the short term in the office space, but we do believe the overall demand for office will come back, and we see the office market as something that will form the base of large wholesale and institutional investors, real estate portfolios. The retail space is definitely split. That non-discretionary market is performing very strong, which we think will continue at least for a couple more years. And at some point, the discretionary, those big malls, will change as well. I would love to thank you all for taking the time to attend today's property update. I've really enjoyed my time speaking here. And if there are any other questions, please do reach out to myself through the Charter Hall website. Thank you very much.
Presenting now is Versailles Capital. Versailles Capital has come up with a different approach to the traditional buy and build model. Here to talk further about this opportunity is Jim Castanet, the Managing Director and Co-founder.
Hi everyone, my name is Jim Castanet and I'm the Managing Director and Co-founder of Versailles Capital. So Versailles Capital provides early stage and off-market investment opportunities into large, high-density and mixed-use property development projects. Now, what the majority of investors do not know is that most property development gains are made in the front end. So by getting in and out as early as possible, we at Versailles make tangible opportunities more accessible, more often, and with much less risk. Now, the problems that investors face are these. One, access to large development opportunities is limited, and there are enormous barriers to entry. Two, they are only offered small back-end returns and therefore miss out on the big gains. and the big paydays. And finally, large developments often take a long time to complete, carry construction risk, and require large amounts of capital. So the investor, that's you. For you, this means opportunities to invest in large developments are few and far between. The return on investments are low. And of course, the investment turnaround times are also very slow. So there is a lack of opportunity to invest. Most large development opportunities are only available to well-established players who are well-connected. There's a limited number of quality investment opportunities. Most opportunities are in poor locations, have low yield and high delivery costs, hence carry significant risks and provide limited returns. And finally, traditional developments can take up to 4 to 5 years to complete, leading to added risk, cost overruns, and they are vulnerable to economic shocks. The result, of course, is delayed return on investment. So the longer a development takes to complete, the less profit you will get. So VC has found the solution. We do all the upfront work to maximize uplift value, including optioning the right land at the right price, obtaining all the planning approvals to achieve the highest and best use, and make the site development ready to on-sell for significant profit to our developers to build. So our unique site acquisition strategy, our secret sauce, if you like, using call options, allows us to secure sites off market by dealing one-on-one with landowners. The use of call options allows us to secure property for a minimal amount up front, hence reducing risk and maximizing returns compared to the traditional method of buying the land outright. Let me run through a comparison of our option strategy to the traditional method. So you can see here the purchase price of land is $44.5 million. The purchase price of options, that's for the fees, option fees that is 1.485. So the projected cost to obtain DA is the same for both, 2.915. The total project cost, therefore, 4.14 using options, 47.415 million using the old method of buying land. So the value of the land on obtaining DA is 74 million. So the gross return on the project, if you're using options, is $25.1 million. And indeed, if you're using the old traditional method, it's $26.5 million. However, when you look at the percentage return for the options, it's 570.45% as opposed to 56.06% if you buy the land. So by using options, the risk is $4.4 million compared to buying the land, and the risk there is $47.4 million. By the way, the return can be as much as 10 times the traditional method. So the advantages of using the Versailles capital strategy when compared to the traditional industry practice of buying land outright are these. So for the construction developer, large capital investments required. For Versailles capital strategy, relatively small amount of funds required. For the developer, external funding required to build. Versailles, no debt required. Construction developer and product off the plan pre-sales are required. No such thing required for Versailles. We simply sell the site wholesale to developers. 4 to 5 years investment term for the construction developer. Versailles, 18 to 24 months investment term. There's a builder risk if you like, for the construction developer. Of course, there's no such risk for Versailles. Similarly, market risk in having to sell the finished apartments and off-plan sales for the construction developer, as opposed to no market risk in having to sell completed developments or apartments by Versailles Capital. So let's have a look now at the market for property development projects generally, and also population growth. So all the major capital cities are predicted to increase substantially by the year 2053. Melbourne and Sydney are set to treble in population to approximately 8 million in each city. There's already a shortage in supply, hence there are enormous opportunities for the property development industry, particularly for experienced players. And on that note, And before I provide you with our investment opportunity, let me introduce the Versailles team. So collectively, the VC team has well over 110 years experience in property development, accountancy, financial services, funds management, commercial and residential property valuation, taxation and business structures, investment management, and trustee services. We have a lot more information about each of the individuals on the website, so please do visit and inform yourself there. So the VC team, by the way, also is well supported by a hand-picked team of solicitors, accountants, architects, town planners, quantity surveyors, and other consultants, including the ones that you see here. Again, please visit the website for more information. So allow me now, please, to present you with an opportunity to invest. Our valuation is currently at $20 million based on forecast target earnings of $5 million on each property completion per year. But of course, our goal is to manage 3 properties per year. To date, Versailles Capital has raised $5.5 million for our shares in our initial share raising in 2019 and our subsequent property ventures. We are now seeking a second capital raise of $3.173 million, which represents 14.4% of the company, to continue our property acquisition strategy and our growth phase. The funds will be distributed in the following manner. $1.5 million will be used as initial investment to acquire site number 3, $1 million as the initial investment for site number 4, $500,000 to establish Versailles Capital Property Fund, and $173,000 to keep Versailles Capital running the operations. So in regards to our milestones, let me advise that over the next 12 to 18 months, we plan to achieve crucial goals that will directly contribute to the valuation we mentioned before. So July 21 this year, that is, we will attain the 3rd project in September of this year. We will attain the 4th project September of this year as well. We will receive the planning proposal approved for the site at 8 Sorrel Street, Parramatta. In December 21, we will open for investment in our residential fund, as we will also do for our commercial fund. In June 2022, completion of project at 15 Hawke Street, Huskisson. And finally, September 2022, we'll see the site of 8 Sorrel Street, Parramatta. So to conclude, our investment highlights are to attain 3 new sites per year, list on the ASX in 2024, funds under management to reach $50 million within 3 years, achieve $1 billion worth of property projects under management overall. So thank you for your interest in Versailles Capital. We look forward to supporting you on your investment journey. All the best and bye for now.
Presenting now is Capital Prudential. Capital Prudential is a fund that continuously purchases, develops and sells a diversified, de-risked portfolio of residential and commercial properties. Here to talk further about this opportunity is the Managing Director, Samuel Moore.
Welcome. I'm Sam Moore, the Managing Director of Fund Manager Capital Prudential. The Capital Prudential Diversified Development Fund offers high-yield, fixed income investments from exposure to property development. Typically, property investments provide targeted returns, expected durations, and exposure to a single property. Our fund provides investors with certainty of returns and duration through issuing unsecured notes backed by a diversified portfolio of property developments. Capital Prudential was founded by our team of directors in 2019, a lawyer, accountant, banker, and developer. I'm a finance professional and lawyer with international and domestic experience. Jared Haynes is our property developer. Scott Fleming is a chartered accountant from Big Four firm KPMG. And Philip Rickier is a banking executive. We're all highly experienced in our professional disciplines. I've been a lawyer here in London and in Sydney in international banking and finance. Scott had 32 years at KPMG, 16 as a partner, always in real estate, running their real estate practice in Sydney for Australia and then in Canada as well. He's now CFO at Beaumont Tiles. Philip's a career banker with a 23-year career at Bendigo and Adelaide Bank and has been a group executive there and worked across all areas of the bank. We're supported by a strong management team. The fund's developments as at 31st of March are shown here. They're all suburban infill in Australian capital cities. We've started in Adelaide where we have the relationships, networks and experience. There's no high-rise, no greenfields or urban fringe developments, and we have diversification across builders and other professionals. In terms of upcoming developments, these are those that have been identified, the land's been secured, and they're currently being de-risked by us as the fund manager. This includes obtaining planning approvals and achieving minimum pre-sale level. If they're efficiently de-risked, then we intend offering them to the fund. And if the fund purchases, and they purchase at cost, we as the fund manager take no uplift. We have some larger former commercial sites that have been appropriately staged, and we're currently de-risking them through environmental due diligence, planning and pre-sales. These are balanced with smaller developments to maintain acceptable portfolio diversification. Our role as fund managers to maintain a healthy de-risk pipeline for the fund, with properties exiting the fund at the same time that new properties are entering. This manages the fund's exposure to the peaks and troughs in the housing market and more latterly construction costs. Diversification across local government postcodes is another risk management strategy. In terms of commercial developments, again, we as fund manager at our cost source, secure and de-risk opportunities for the fund. These are opportunities that have been secured by us and if de-risked will be offered to the fund at cost. For commercial developments, de-risking primarily involves planning approval and a long-term legally binding agreement for lease being in place with a creditworthy tenant. This ensures there's a highly liquid market to sell the property into following practical completion. So REITs, institutionals and high net worths. The directors have recent track record in these types of commercial developments and for funds of this nature. We've leveraged our relationships and networks to build a strong pipeline. Commercial developments are tenant driven and with tenants operating nationally, this provides the fund with national diversification. The fund has minimum investment criteria both for residential and commercial developments. The fund manager's role is to use its own balance sheet to identify, secure and de-risk development opportunities so that they meet the minimum investment criteria. Any that don't and can't be offered to the fund are at the fund manager's cost. The fund's role is to purchase at cost, develop and sell. The fund is audited by KPMG and we use one registry as our independent note register. We're raising $12 million into the fund for its development pipeline. The fund is structured as a special purpose unit trust issuing unsecured fixed income notes like an RMBS structure and debt security. 3-year unsecured notes pay 8% per annum. Other terms and interest rates are available. Interest is paid quarterly and principal is repaid at the end of the term. The unsecured notes are only available to wholesale investors. Thank you for your interest and please get in touch for further information or to request an IM.
Crowd Property is a specialist marketplace lender providing finance for property projects. Here to talk further about this opportunity is the CEO and co-founder, David Ingram.
Hello, my name's David Ingram. I'm the CEO and co-founder of Crowd Property Australia, and I'm very excited today to be sharing this investment opportunity with you. We are a property lending platform specialising in bringing together wholesale investors like yourself with small to medium-sized property developers. And one of the things I think you need to know is we've done this before. So personally myself, I've co-founded and successfully exited a prop tech marketplace business before, perhaps before it was even known as that. These days I'm more excited about working with the founders of Crowd Property UK, who you may have seen on here. They have successfully funded 200 million small developments, over 1,500 residential developments in the UK. And they've got nearly 15,000 investors on the platform over there, which they've built up over the last 7 years. And I'm pleased to say they've delivered a flawless track record of 100% principal and interest return to date. So we're also benefiting from those 7 years of experience and all the IP, which have been transferred to the UK, and we softly launched the platform here in May this year, raising 2.5 million to date, and we've got a good pipeline growing of just over 50 million. So to give you an idea on the type of projects which we're funding, we fund small developments. You can see here there's some examples of what the UK has funded, and importantly it's to note just how quickly they've been funded on the platform. We've over 2,000 lenders coming in, investors coming in like yourselves, and fully funding projects in less than a minute. So even throughout COVID, this kept up with projects funding in 53 seconds, 22 seconds. In Australia, it's taking a little bit longer as we're just getting going, but we have successfully got 3 project phases away now of diverse projects, which we will come back to. Why are we here? Well, I went looking for a technology solution which helped something we were doing already, which was helping small developers who really were lacking access to banking finance for a number of reasons. And we know even if you can get into banking finance, it's complex, it's slow, it's an expensive process. There's a complete lack of transparency involved in this, and you really aren't talking with people who necessarily understand property. These are some of the real quotes which we've heard and captured. You know, my favourites there: banks might be cheap money, but it's a higher price you pay in the end. Nobody understood property. You need to talk to someone 3 layers up to get a decision. Now, these are some of the problems that we were helping to solve at Crowd Property. We know property financing is complex and expensive, and everyone wants to clip the ticket on the way through. So the solution? Well, the solution is simple, and it's also therefore profitable. So we cut out a lot of the middlemen here. So we want to have a direct relationship, directly originate loans. So you'll see loans here which you won't see otherwise. But that enables us to start our due diligence process from the moment that a developer picks up the phone and calls us. It's when we start talking to them. It also enables us to cut out the costs and pass better returns back to our investors. Speaking of the other side of the platform, there's a significant amount of money. You can see over $1 trillion which is sitting in household bank deposits at the moment. Property, residential in particular, remains a very strong asset class, and we've seen that with the recent house prices, but it's still very hard to actually get into that with a lot of overheads, a lot of sunk costs which go into that. And what we can bring through the property platform is a way to diversify that. And that's particularly relevant for those of you who've got self-managed super funds. As you may have seen, the ATO sent out, I think it was 19,000 letters to self-managed super fund trustees earlier this year, basically advising them that they had a concentration risk of a single asset sitting in their portfolio. So we're really helping those trustees with diversifying their portfolios. What is it we do? Well, it really is property finance by property people. And what does that mean? Well, for property developers, that means we can provide initial decisions quickly. We can provide that speed, ease and certainty that they are looking for. There are no hidden fees, there are no broker fees, there's no last minute changes. For the smart developers out there, they're already using the platform in the UK to help build their brand. For wholesale investors, we know security is your priority. All our projects have first mortgage security taken out on them, and we provide returns in a 6 to 18 month period, typically 14 months. We're targeting a 7% per annum return, and not a project goes up on the platform without going through our strict 53-step due diligence process. So I think you've probably gathered by now the UK is a remarkable success story and growing quickly, but I'm pleased to say Australia is as well. So having softly launched in May, we already have booked 75,000 in revenue. By the end of this month, I'm expecting that to be closer to $250,000 with a growing pipeline behind that. So we went out and did a pre-seed raise during COVID times. We actually oversubscribed that by 50%, raising 750,000. Since then, we've built a really good team. We'll talk about more about them later. We've embedded ourselves in the small developer networks here, and we've built a great relationship with a third-party trustee in Key Fund Services who provide our AFSL. And we've been getting some traction in the press, as you can see. So that's getting out there. If you've seen any of the industry papers, you've been seeing we've been getting some coverage, which is helping with the projects coming in. And as I mentioned, the team are all very experienced and focused. They've been there and done this before. So Tony Zulli in particular, who's our CEO and other director in the business here, he's got a track record of 30 years of experience in the financial services industry, including with an RM on his own funds and license. Daniel He is our property director. He's a great guy, interesting background, and he was an optometrist to start with, but his real passion is in property development. He's developed small projects up and down the East Coast, and he's got a particular focus on Adelaide with about 3 or 4 projects on the go down there at the moment. And then we've got Jamie Miller, who's looking after our marketing and growth, who I've known for 20 years. We're also benefiting from the UK team, which is now 40 strong. And we not only benefit from their grey hair and their property expertise, but also from their tech team and marketing teams who are supporting our growth here. So we're seeking wholesale and institutional investors who are interested in the efficiency that our fintech platform provides, but more important than that, they also appreciate that the expert due diligence which we do on our projects and the fact that we directly originate that pipeline ourselves. There will be a seed round coming, and there's a bit of a teaser for that and why you should be looking out for it on the CRIISP platform. Is that investors who came in at the same stage in the UK are now sitting on a 22x times return. And as a co-founder will tell you, it's even greater than that when you take in advance tax advantages. So look out for that one. It's coming soon. So in short, we have a proven business model with local expertise in scaling property and technology businesses. And we have an appetite for not just the Australian market, but scaling this across New Zealand and even into Southeast Asia. But what I really want to talk about is something you can get involved with today, because we want all our investors to actually be active on the platform. As you can see, we've got a good pipeline of projects coming, everything from co-living to land subdivision through to your traditional townhouse builds. And I'll talk briefly a little bit about a land subdivision which is live on the platform today and why the Crowd Property team likes our project in Salisbury Heights. As you can see from the aerial shot there, it's the next logical bit of land really to be developed. Our developer, Fee Lee, has done a great job at actually securing that bit of land and also securing a DA approval for the subdivision of that land. We also like this project because he's got a fair bit of skin in this game. He's looking at keeping one of these lands, retaining one of these plots to build his own family home on, which is very consistent with that area of Adelaide, if you know it. Very popular with families establishing themselves and first home buyers. One of the preconditions for putting this project up on the platform and offering the loan is that he settles pre-sales, so there is 50% pre-sales requirement on this, and I'm pleased to say he's on track for that, selling 1 unit a week at the current rate with his existing sales team. He's also put together a really great team around him, and you can read more about this on crowdproperty.com.au, but suffice to say, one of the project managers in there has pretty much been responsible for most of the land subdivision in that suburb, so a lot of good expertise in there as well. Again, more detail available on the platform, but in short, Crowd Property will be raising $1.4 million for phase 1 of this project, targeting a 7% return. The total loan facility we will make available is $4.2 million, and this is against an end sales value or GRV of $6.2 million. That gives a loan to GRV of a little over 60%. And these will be drawn down by the developer in 7 phases over the project. So don't worry if you miss out on this one. There will be more phases of this project coming. So in summary, as investors ourselves, we understand security is the number one priority, and that's why our expert due diligence is so important in this process. We also take out first registered mortgage security on all the projects which go up on the platform. Returns are short in a 6 to 18 month period, and we are targeting a 7% per annum return for that. So you can come onto the platform, you can be selective, or you can drip feed your self-managed super fund monthly into the projects which are coming up. And we're going to be working very hard to ensure that we maintain our track record over the last 7 years of 100% return on capital and interest. So if you have any questions, and I'm sure there will be some, feel free to reach out and get in contact with myself personally. My details are here, or reach out through the CRIISP platform. Thank you very much for your time today, and hopefully talk to you soon.
Presenting now is EG Private Wealth. EG grows the wealth of their private investors through commercial property syndication opportunities. Here to talk further about this opportunity is the Head of Private Wealth, Rodney Walt, and the Head of Capital Transactions, Sean Fleming.
Hi, I'm Rodney Walt, Head of Private Wealth at EG.
Hi, I'm Sean Fleming, Head of Capital Transactions at EG.
Thank you for joining us. We look forward to presenting to the Wholesale Investor. EG invests and develops real estate on behalf of super funds and private wealth clients to generate outstanding returns for investors and lasting positive social impact for communities.
EG manages the full cycle of your property investment, from asset selection and negotiation, undertaking a comprehensive due diligence process, structuring of the transaction, ongoing asset management, and ultimately divestment management.
EG was founded in Sydney in 2000 by the Easton and Kahar families as a specialist real estate fund manager. We built a name by investing in yield-producing sites along transport corridors and taking those sites through to rezoning. Today, we manage $3.2 billion in assets under management and have a development pipeline of $4.3 billion. Over the past 20 years, we have developed a proven track record in successfully identifying, acquiring, managing, repositioning, developing, and exiting sites across Australia. We are headquartered in Sydney with a team of 60 staff across Australia, Manila, and the US.
EG's institutional systems, processes, and access to off-market and pre-market deal opportunities through our extensive brokerage network are made accessible to high net worth individuals and family office clients. EG's data-driven approach to asset sourcing and our approach to assessing and pricing risk allows us to safeguard investor capital whilst maximising returns.
The EG difference has been built on 3 pillars. People first places. Building good, BIG, thinking is our unique approach to generating both outstanding returns and lasting positive impact. Much of our success as a real estate investor comes from thinking big about opportunities to create legacy. Technology. We have invested heavily in property technology, developing our own proprietary property risk management software, PRISMs, to ensure that we are unlocking every opportunity for our investors while minimizing downside risk. PRISMs. PRISMs is used to measure, price, and manage the various risks attached with commercial property investments. EG requires all assets to be assessed by PRISMs to ensure relevant risks are identified and priced and appropriately managed post-acquisition. I truly believe this has led to our success and track record and never selling a commercial property at a loss. Culture. The people at EG are critical to our success. We have created a unique culture to ensure we attract and retain an entrepreneurial team of individuals empowered to deliver more. EG's vision is to be the light on the hill in the funds management industry. We believe we can achieve this by setting the benchmark in funds management, change and improve the way savings are invested, and lead by example. Private Wealth was established to provide high net wealth and family offices access to deal flow of commercial real estate, including access to institutional systems and processes, delivering above average returns and capital security, a personalized and aligned approach to every opportunity, data-driven, tech-enhanced approach to uncover new opportunities and enhance returns for investors. To date, we have invested $250 million of private wealth in property, achieving an average return of 27.8% IRR.
EG, through its extensive brokerage network, regularly assesses opportunities for our private wealth division. Given our national footprint, we constantly assess opportunities and values across multiple markets and sectors. Our deal flow opportunities target properties with a robust downside position via the sustainability of income and physical building improvements and acquiring assets that have multiple future exit strategies. EG also adopt a counter-cyclical view on markets using our data-driven approach and invest in opportunities whereby stable income distributions can be delivered and capital growth potential exists to offer additional protection for investors. Often EG will co-invest and in many instances will provide a first loss position with that investment. The Belrose Property Trust was established in early 2020, initially targeting quarterly cash distributions of 7.25% per annum. The trust comprises a multi-tenanted industrial estate on the northern beaches of Sydney and required some active management from EG to increase the weighted average lease expiry at settlement, which is 1 year, to nearly 4 years as of today. Throughout the turbulent COVID period, EG managed to stabilise the asset and increase distributions from 7.25% per annum paid quarterly to 8% per annum. The EG Long WALE Trust was established in late 2020, with EG negotiating a 15-year triple net sale and leaseback to a leading international dealership network of Toyota vehicles. The property is located in the inner eastern Brisbane suburb of Morningside and will initially provide investors with a secure cash distribution of 7.25% per annum paid quarterly. EG will be undertaking some refurbishment works on behalf of the investors shortly after settlement and expect to see the investors' distributions to increase to in excess of 8% per annum.
Sean and I have both worked for EG for over 10 years. Please feel free to view our background on the EG website and connect with us on LinkedIn or email us. The executive team consists of our founders, Michael Eason and Adam Gahar, the E and G in EG, and the executive directors, Roger Parker and Mark Turner. We are interested in connecting and sharing with you our property syndications opportunities. Please reach out to me on rwalt@eg.com.au or via the Wholesale Investor platform to learn more about our next offer.
Presenting now is PWE Capital. PWE Capital have developed high-frequency trading algorithms which, when combined with their proposed direct-to-bank trading environment, extracts substantial gains from the biggest market in the world, the Forex market. Here to talk further about this opportunity is CEO and co-founder Manas Kumar.
In the time it took this Formula One car to drive by, our high-frequency trading algorithms could have executed dozens of trades. We are breaking down barriers and crossing new horizons in the world of trading, all with one aim: redefining ROI. Welcome to PWE Capital, an algorithmic trading firm that's here to amplify your investments by generating better returns than conventional fund management models. Unlike traditional hedge funds, our focus is on the biggest and most liquid market in the world, the currency market. With over $7 trillion in daily trading volume and access to top-tier prime liquidity, we are tapping into the one place where the opportunities clearly outweigh those in traditional asset classes, be it fixed income, real estate, equities, or even alternative investments. In this post-pandemic world, old norms have been challenged like never before. Fundamental drivers of value and growth are no longer in lockstep with what we see in the market today. Something has changed. In fact, as we've heard so many times, this is the new normal. In the current low-yield environment, the traditional asset allocation models are expected to generate lower returns over the next decade in comparison to the performance of the last 40 years. Across the board, from fixed income to real estate, sophisticated investors of other asset classes are facing diminishing returns, heightened uncertainty, and the prospect of dwindling yields. These are truly unprecedented times, yet in the midst of all this turbulence, there are opportunities just as unprecedented. Take the currency market, for instance. It's bigger than every other market in comparison. Despite this vast liquidity, returns have been shackled by conflicts of interest. It's the rampant losses resulting from these conflicts that have pushed the currency trading vertical into a higher risk basket than, for instance, equities or fixed income. If there was a way to address this broker-induced leakage of performance, the long-term impact of such a move could be so profound that an entire generation of fund managers will sit up and take notice.
Our approach to currency trading isn't something new or untested. High-frequency trading has been around for quite some time. Risk management models exist which have been tried and tested for robustness consistently. However, those same models are not immediately transferable to the currency market. Besides the significant volatility, which isn't necessarily an indicator of risk, there are other aspects of trade clearance that make high-frequency trading in the currency market quite challenging. Inherent market risk we can manage. In fact, in many cases, we can use clever math to actually capitalize on market chaos. What couldn't be controlled by trading excellence alone was the involvement of retail brokers. Brokers routinely manipulate conditions for their own personal gain by bebooking the trades or distorting real spot prices and inserting delays at the time of order execution. It shouldn't be this way because this introduces undue risk in what would otherwise be absolutely fantastic for high-frequency trading. So we decided to take a radical approach and remove retail brokers from the value chain entirely. It is for this reason we invested heavily in establishing a direct-to-bank trading environment, one where we control the order flow, where we would be the masters of our own destiny. The sheer speed advantage we've created with this approach, combined with our algos and proven risk management strategies, puts miles between us and others in the industry. This is what equips us with the ability to achieve our single aim of redefining ROI.
Every once in a while, a new player emerges. One that brings clarity and purpose during times of uncertainty. Someone that dismantles a broken system and reassembles it with only the best parts that drive efficiency and performance. It's then that a paradigm shift begins to take place. A shift towards something bigger, better, and smarter. Your wealth deserves a smarter approach. So if you're a family office, an asset manager, or a professional investor, please ask us about our investment program. It could be just what you need in these challenging times.
Presenting now is MaketoRent. MakeToRent are a WeWork style approach to residential letting. Here to talk further about this is founder Tim Bennett.
Good morning. My name is Tim Bennett. I'm the founder of MakeToRent. MakeToRent is a new fund created to take advantage of the distressed section of the property market. It has been designed to deliver both dividends and a share of the asset growth over the life of the fund. It's not an exaggeration to say that the world of work has changed forever due to the recent pandemic, with companies small and large deciding that it's preferable for employees to split their work time between home and the office, and in some cases doing away with centralised working altogether. Little did we know when we embarked on the MakeToRent project 3 years ago that it would have the potential to provide solutions for mental health, the environment, and more importantly, people's work-life balance. What has been acceptable for landlords historically, furnished or unfurnished spaces, we believe will give way to a more holistic living experience. One we have been planning for a long while, where working from home involves exercising and working from on-site facilities, where rent, utilities and things like concierge facilities are provided through a single monthly fee. The tenant will no longer have to worry about being in to receive parcels or picking up their dry cleaning. They simply provide those instructions to the concierge and go about their business. From the investor's perspective, they benefit in several ways. Firstly, from the development profit created through either the purchase of a distressed asset or by building out a planning-approved site. Secondly, through asset appreciation in a burgeoning UK market. And lastly, by dividends created through rental income. Yes, this chart is at the upper end of our calculations, but we'd like you to consider the following. Firstly, that as an investor, you own the asset, something not the case with similar concepts in the office rental space. Secondly, as an A-class preferential shareholder, your fund management fees are returned on exit before any profit share with management is calculated. There is a full stress test for this in the investor information pack, which is available by self-certifying through our website, www.maketorent.com. In assembling the team for this project, we have combined both financial and regulatory experience with that of construction and operations. Shona McKenzie, for example, has 4 decades of financial services experience and is widely credited with the birth of regulatory hosting in the United Kingdom, as well as spending 15 years as a US institutional stockbroker and advisor to family offices. Putting together the advisory team was altogether more challenging. All known to MakeToRent directors for a considerable period, it has taken incredible fortitude and patience to assemble. To give an example of this, it took 7 months to obtain Barclays approval to add Chris Ball, the Vice President at Barclays Wealth. Transparency of operations is a cornerstone for MakeToRent. From early planning sessions with our lawyers in 2019, investor communication and regulatory rigour has been our focus. Financial regulation by the Financial Conduct Authority is amplified by information provided by both Sturgeon Ventures LLP, the fund manager, and Mainspring Fund Services, the fund administrator. The latter providing a secure and personalised portal space for every investor. The interesting thing about these graphs showing continued asset growth in the United Kingdom property market over a 12-year period is the fact that distressed opportunities still existed during this time. Why do we feel confident in replicating this in the future? It's because we use state-of-the-art software to analyse potential deals and work back from our target returns. something I learned from friends at Hanson Trust many years ago. Everything about make-to-rent operations is digital, from investor onboarding to tenants' application and rent payments. Are these modules proprietary? Absolutely not. We are focusing on being a world-class real estate team, not software provider. There is a host of fantastic software that we have personalised for this project. The initial raise is for 20 million and is to refurbish or construct 1 or 2 apartment blocks. In return, investors receive A-class preferential shares, 100% of dividends created through rental payments, and 50% of the asset growth. Uniquely, as mentioned previously, fund management fees are returned on exit prior to the calculation of profit sharing with management. We have designed the tenant experience to be seamless and deliver robust and stable returns to investors alongside the appreciation of the distressed asset. They will apply, sign contracts, check inventory, pay rent and raise any issues through a personalised app. Their occupation, utilities, broadband and facilities, as previously mentioned, are provided through a single monthly fee. Finally, we are active on social media and there is a frequently asked questions section on our website. Please take time to have a look at this. It leaves me only to thank you for listening and we look forward to answering any questions you may have.
Presenting now is My Property Solutions Sydney. MPSS investors receive regular interest payments from an established company with over a decade of rent collections from the Sydney rental market. Here to talk further about this opportunity is founder, Delwyn Seeler.
Hi, my name's Delwyn Seeler and I'm here to present for My Property Solutions in Sydney. MPS is offering investors an opportunity to invest and receive a 7% per annum return and a steady interest payment through the cash flows we collect from an existing rent roll business. Our business focuses on property management and I'd like to talk to you now about the opportunities that presents in the marketplaces. Firstly, I'd like to talk to you about the Australian rental market. Approximately 30% of all Australians rent, and this has been the case over a number of years, in fact almost more than a decade. The important thing here is the dotted blue line that you see on the presentation, and what that's showing you is the continual rise and growth of the rental market here in Australia. Further to that, there's a second player that's come into the Australian rental market, and that is self-managed superannuation. Australia boasts the 4th largest pension market in the world, and basically 15% of self-managed super funds in Australia hold some form of direct property. And that continues to grow. There's a third market. That market is within the industry itself, and that relates to the opportunity presented to licensed real estate agents to purchase other businesses, other rent collection businesses, and thereby grow their cash flow and their business into the future. There are barriers to entry into this market as only licensed real estate agents can participate. To put that all together, I've used the following slides. What brings this whole process about is an opportunity that's been created by the continual increase in legislation and requirements imposed by state governments. What that means is that it's become increasingly difficult for people to manage their own properties, and thereby that increases the opportunity to us. It's also meant that small and medium-sized real estate agencies are finding it increasingly difficult to manage their rent roll and thereby looking forward to selling that rent roll in the future. MPSS has been strategically placed to take advantage of these 3 markets. How we do that is we've had a hard look at the way the industry operates and we've addressed the key issues that limit growth in the property management business. The first simply is that most agencies are run by real estate principals whose focus is sales. That's very different to the detail and the systems requirements that go into property management. So most agencies are actually having their rent roll managed by property managers, and that's forcing up the cost of property management and thereby affecting margins. We've addressed this situation by recruiting outside the industry. There's another area where agents have tried to grow their business, and that is by expanding the number of offices that they have in a particular area or suburb. This is a very expensive method of expansion as it duplicates all costs. We've looked at that process and we believe that technology and our new system of corporate management has solved it. Lastly, let's talk about technology itself. The rise of technology is affecting real estate as a business the same as everywhere else. So the opportunity is presented that if we look ahead and take advantage of those technological changes, that we can get a big step forward on our competitors, and that's exactly what we've done at MPSS. We need to look back at our journey to help you get a grip of how we've done this. The first is that back in 2018, I took over the leadership of the business, and I did this to impose a new corporate process and approach to managing property into the future. In 2019, we actually started training our new team into this new approach, and we even made the decision to remove unprofitable parts of the business so that the growth in the business could go on unimpeded. Back in May of last year, we took on our first rent roll. We then followed up with a second rent roll. And why this is important is it means we tested all our solutions, and I'm proud to say that they have worked and worked extremely well. We're now into 2021, and we made the decision to establish a new corporate headquarters, and that establishment has meant that we've been able to cement even further improvements in technology and secure our cost base in terms of rental accommodation over the next 10 years. I'd like to talk to you about our key members of our team that you're likely to meet as an investor. Obviously there's myself, but there's our CEO, Arisi Doolan, who runs the business day to day and has consistent contact with all our property owners and occasionally our tenants. She also runs our division for property management, and through that process, we deal with our owners all the time, all right, directly. I'd also like to talk to you about our new business leader, Anela Falvo. Her role is to go out into the marketplace and source new business opportunities all the time, which means that we've got an additional process to grow our business besides the acquisition of rent rolls. Then there's Tristan, our communications officer, who's the person you'll most likely talk to with regard to your investment, and will follow through with explaining where we're up to with our various changes and advancements through your investment period. MPSS intends to raise $1 million through the issue of Series A preference shares. These preference shares pay an interest rate of return of 7% per annum, and the payment is made available to investors at the end of each quarter. There is an IM that goes through all the details, and the investment minimum for sophisticated investors is $5,000. I'd like to thank you for your time and listening to the presentation, and I ask you to scan the QR code you see below, and that'll give you access to our deal room through Wholesale Investor. Once again, many thanks.
Presenting now is Unhedged. Unhedged is a simple app-based experience that allows everyday investors to assign their money to advanced AI trading algorithms to access higher performance. Here to talk further about this opportunity is the CEO and co-founder, Peter Baker.
Hi, this is Peter Baker. I'm the founder and CEO of Unhedged. And Unhedged is a technology company that enters the fund management industry to bring investing to the future. And we use AI and machine learning to do that. So what are the problems in fund management as we see it? There's several. So the first is that there's a whole cascading AUM fee. And those AUM fees are charged for doing little. In general, it's a static rebalancing that the asset manager does on the model portfolio theory. And most people can do it themselves. If you want to access other types of return streams, hedge funds are usually very accessible. Smaller ones, yes, but the better ones, like the big ones, beyond you have to bring 4 or 5 million to get in. So what do we do? So we have a fund, we have a service that allows investors to assign money to pretty advanced algorithms. And wholesale investors only get charged when we outperform the benchmark. And on top of that, we have no AUM fees. No gain, no pain. So our team is really, really solid, and that shows. We have 3 quants on board, Saskia, Glenn, and Peter. And we have a risk manager in the form of Michael Spuit, who just had an exit to 2X. On the board, we have Caroline Colley, who is also on the board of the ASX. We have Ben Marsham, who is involved in Financial Planning Australia. And we have a bunch of tech and fund advisors that are really adding value to our business. So in total, we have raised $2.3 million. And today, we raised another 1.5. Good news. So we are launching our 3 algo fund in July 2021, in a month's time. And there's an opportunity for you guys to invest. You invest with 0 AUM fees, only overperformance fee, and that's 20% of the overperformance between the benchmark and your account. It's only for wholesale and institutional investors, no retail investors. Minimum of 50K. 50K will get you in the fund exposed to very advanced algorithms. Now you ask, what are the algorithms then? Well, there's 3 algorithms where we launch with, but we will enhance that with other ones. The first one we call Goldilocks. It's been trading since 2018 on our own accounts, and has done very, very well. Only in the last month it did 14%, which is higher than we normally have, right? But if you see in the return diagram, we in general do around 23% a year. The return profile is very skewed. There's no outliers to the left, which is very important. This algorithm looks at the metal complex, and it basically looks at the metal complex, the industrial metals versus the more hedging metals. And we have a priority model that basically looks at the relative movement between the two. The second input, which is very important, is the VX complex. We don't talk about the VIX itself, but more the complex. So the whole volatility complex, or the option structures and the future structures, how they behave. And based on that, we determine our allocation between full markets, levered markets, or bond and levered bond. The next one is our most stable algorithm. It's the tortoise and the hare. And we have this in our set because this algorithm makes sure that the total result, if you combine them, becomes a very low volatile experience. So this is a machine learning algorithm from Marcos Lopez del Prado, and it's called the hierarchical risk parity. We have amended that to put a beta switcher in it. And that means that we jump out of the market or go negative beta when the market goes down. And you can see the effect in March 2020, where we missed the dump, but we not only miss it, but we actually make some money in it. The third algorithm is Alice's Adventures. It's a classical momentum algorithm, but it looks a little bit deeper. It's what we call a quantamental. So it looks at the internals of the companies and then selects the ones that have most momentum. And then we have a additional indicator on it that tries to prevent momentum crashes. We can prevent most of them, not all of them. So this algorithm is a little bit more volatile. But the beauty is combining those three, combine them either in an equal weight or in a dynamic way, and you get a very stable return. And the beauty is you only have to pay if we overperform the benchmark and we hit a high water mark. This is the opportunity. I think this is a unique proposition in the world of fund management. It's unique that we are zero AUM for wholesale investors. It's unique that we are fully automated. There is no investment committee that determines where your money is invested. Fully automated. We trade while you sleep or have a drink. Thank you.
Our panel session for today, titled Property Investment and Development in a Post-Pandemic Environment, will be covering topics such as the insights and opportunities in the property sector, macroeconomic effects on property and other asset classes, concerns over inflation and overstimulus, and how to create value for investors, amongst other things. Talking on this panel will be Jerome Lander, CIO of Wealthlander, Darren Younger, CEO of Bricklet, Troy Harper, Director at Aviator Capital, Ron Shamgar, Head of Australian Equities at Tamim Asset Management, and Rob Hay, moderating, Head of Distribution and Investor Relations at Collins Street Asset Management.
Hello everybody, my name is Rob Hay and I'm Head of Distribution and Investor Relations at Collins Street Asset Management. Today I'll be chairing the Wholesale Investor Expert Panel session on property investment development in the post-pandemic world. Today, we're fortunate to have a number of industry leaders joining us for this discussion, and I'll pass along to our first guest today to share some of his background and area of specialisation in the property market. Ron Shamgar is from Tamim Asset Management. Ron, over to you.
Thanks, Rob, and thanks for having me. So I'm the head of Aussie Equities for Tamim Asset Management. We're a boutique investment firm based in Sydney. We manage a couple $100 million on behalf of our clients in property, credit, and the equity markets. And I've been doing this for about 17 years.
Okay, thanks, Ron. Also joining us today is Jerome Lander from Wealthlander. Jerome, could you share some insights into your background and your area of expertise in property?
Sure. My name is Jerome Lander. I'm a multi-asset investor, absolute return investor, basically been in the institutional landscape in Australia for a very long time. I've now started my own firm called Wealthlander. And basically my relevance, I guess, in terms of this is we deliberately shy away from property, interestingly enough, because we think that a lot of investors have a lot of exposure to property. And what we're trying to do is provide valuable diversification to the property investments that they already have. So we don't have a problem with property. It's just that we think in Australia, people are very exposed. So we deliberately look for investments that are diversifying to property so that we can provide value to people's overall portfolio.
Okay. Thanks, Jerome. Darren.
Yeah, right. So my name's Darren Younger. I'm the CEO of a company called Bricklet. We've only been around for just over 2 years. We're a new prop tech company, and we've been working in the industry around, we provide a marketplace that enables people to buy property fragments, so smaller pieces of property to help people get on the property journey earlier and also help them build a much more diverse portfolio. So, that's kind of my background.
All right. Many thanks, Darren. And Troy, perhaps you could share some of your background for our audience as well.
Sure. Thanks, Rob. My name's Troy Harper. I'm a director of Aviator Capital. We are a property fund that focuses on office in the sub-institutional space. We're looking for your traditional value-add assets. We come from a background where we've got, my background is property and construction, so we look for the nuts and bolts of assets. We're very much, if you like, old school property. We like to look at the fundamentals, see where the growth opportunities are, and then, invest accordingly.
Okay, thanks, Rob. And so while I'm with you, could you share with me your insights into what impact COVID has had on the property sector and where you see the opportunities in the property market over the second half of 2021? And importantly for our audience, if you have any tips on how investors can take advantage of these, it'd be great for you to share those as well.
Sure. There are a number of things that we've noticed throughout the COVID journey, if you like. We're really kind of got a bit of a two-tier market at the moment. We're strictly in commercial real estate. When you look at commercial real estate, you're looking at A grade, like government AAA tenants being in some respects oversold. So the better the covenant, the more demand there is. And yet you're then seeing in some respects a slower or a slowing of demand for B grade assets as it's harder to backfill those types of tenancies, or those types of tenants perhaps haven't come through COVID quite as strongly as you would have hoped. And that's one of the things we're kind of seeing is that, there are opportunities out there, but there's also still a lot of pain out there in commercial real estate. There's a lot of businesses that are not necessarily going so well. And so that's always something to keep in mind. We think it's our view is really hardening very much during COVID. That you've got to look at the fundamentals, and the easy ride of yield compression, of constructing a portfolio with a bunch of potentially suboptimal assets that by themselves weren't so strong. That is starting to become a real issue, or has become an issue with COVID. You really want to, the quality of your tenant, the quality of their business, the quality of their position, the defensibility of where and how they operate is really crucial. And then it's back into more basic fundamentals like how you, looking at leases, making sure that there are opportunities there for growth, preferably net leases that give you some protection against inflation and those sorts of things which we see into the future. In terms of opportunities, we see the last half of the year really being characterised by uncertainty. We see still a lot of, as government stimulus unwinds, as businesses return to normal, as people are coming back to the offices, you're seeing, I think, a bit of a yo-yo. You've seen people move away from office. You're starting to see people realise that actually their social life, their day-to-day life, their working life has been seriously impacted. Their productivity is not what it should be. It's not that much fun being at home with everyone all the time. So we're seeing those. So I think we're going to see a bit of a return to normal. But in terms of we're seeing, in terms of hard opportunities, what we're looking at retail. We think retail's probably been a little bit oversold. I use this as an analogy. I've been spending a lot of time in Melbourne recently in the CBD, and it isn't a great place without retail. It isn't a great place without restaurants and cafes. And I think people will realise that they've lost something a bit more than just their time in the city. It's a quality of life aspect as well. So I think we're going to see more. We've got a lot of interest in distribution centres, but that whole sector's been oversold with the view of being last mile for e-commerce and things like that. That's all great. But I think the real quality of life stuff has been oversold. I don't think we're going to see a wholesale departure from the CBD. And I think the actual interactions that we have day to day, whether that be with restaurants, retail, etc., those things are coming back. So those types of sectors, I think, certainly on Aviator's radar, for future investment.
Okay. And so, Darren, what insights do you have here? What do you see the impact of COVID having been, and where do you see the opportunities within your business?
Yeah, I mean, it's definitely been an interesting time. I mean, we had the platform up and running before COVID, and we sold over $9 million worth of bricklets at that time. And, obviously COVID slowed things down, but as we're all seeing, the property market is heating up a lot, and there's a lot of opportunity, out there at the moment. So, I mean, the Bricklet platform is really there, to help people, do more with property, and get more access to property. So, it's all about, if people want to, get on property ladder for the first time, we're finding a lot of tenants that are wanting to get onto the property ladder. We're also a lot more about the diversification as well around our portfolio. So there's a lot of our clients, probably in fact more than 50% of our clients are using their self-managed super funds to buy property. So, getting a direct exposure to property, but having that across a diverse range of different property, and one that we'll be evolving into, more asset or more real estate types, I guess, so looking at doing the first commercial project, sometime in the next few months as well. So we've got, there's a lot of things happening. I mean, we're doing some good projects with both Mirvac and Stockland. They're our seed investors, and what we actually have planned for the market is going to be quite interesting. But it's more around giving people that the opportunity to be able to invest in smaller amounts. Now, the typical value of a bricklet is 20 to 25,000, but a lot of investors, it's still there for those sophisticated investors. Some of the projects, I think the biggest project on there is about a $9 million project, right? So it's still, you still could have a significant amount of that. It's just, smaller shares. It's no different to, having a piece of, say, BHP and having the shares. The share price is quite low, but you could have a large allocation. So, it's not just for those smaller retail investors, but also for, for larger players as well that want to kind of create that diversity in their portfolio.
Okay, very good. And so, Jerome, you mentioned before that property is something that you tend to steer away from as a general principle. Do you tend to steer away from all subsectors within property? And if so, how do you go about building out diversification to manage some of the risks that your clients who are overweight in that asset class might have?
Yeah, I think that you've got to put the take a 30,000 foot view. You just take a step back and just say, look, what's actually going on with the economy and with asset prices generally. And look, we take the view that we're in a bubble across multiple asset classes, really, that's being driven by incredibly easy policy, basically. So we've had the COVID shock. The system fell apart, had to be rescued, and they've overdone it. Right, basically, they've stepped in with all guns blazing, pushed interest rates to zero, massive fiscal stimulus. Clearly, it wasn't a bubonic plague, COVID, but they treated it as if it is. And so government's spending an extraordinary amount of money to basically support asset markets. And that's what we're seeing, and try and support the economy, sort of the secondary thing. And so we see asset prices across the board all being driven by what we call common risk factor. And this includes property classes as well, bonds in particular. Obviously, you've had a long bull market already in property. You've had interest rates go down to near zero. This is arguably about as good as it gets in terms of the support and stimulus and what you can expect to see and what's been imputed into prices that we're seeing today, right? So when you see yields go down to zero, it really, beyond going to negative, it's hard to imagine how it gets much better. You've got massive quantitative easing programs, you've got, huge amounts of liquidity, pushing up confidence and people imputing fear of missing out across many property markets, and you can see it in residential. Obviously you've got some dispersions mentioned earlier by one of the speakers in terms of, whether the sectors have been affected by COVID or not. So, there's a difference between retail and certain other aspects of commercial, and there is from sort of A-grade commercial and harbourfront high-end property, which is really exposed to those sectors of the economy that have done really, people have done really well basically, and they've been able to step out there with all this government money and basically pay huge prices for stuff. And so, we think if you look at the fundamentals, property doesn't really stack up very well without leverage, generally speaking. The returns are pretty low in terms of yields. And so what we're doing is really looking outside, trying to get away from that, and looking at active, value-adding opportunities that don't depend upon markets going up to thrive. Because sooner or later, the party's going to come to an end, and when it does, it could be pretty shocking. And so we think it's important for investors not to have all their eggs in one basket, so to speak. And they don't have, by having all your eggs in one basket, you don't have to be all property. You're basically exposed to this interest rate phenomenon, this policy phenomenon across multiple different asset classes, really have the same underlying risk.
Okay. So, Ron, do you share this view? Are we in bubble territory here, or do you have a different perspective on the property market and where the opportunities might sit throughout 2021?
Yeah, sure. I guess we like to take more of a big picture view. If we look at the pandemic and the actions of the Australian government in response to COVID, I don't think it's necessarily changed the fundamentals of the Australian property markets and the residential market. But I think it's actually created some really interesting dynamics that we've noticed, such as, for example, working from home. I think companies have really adopted, to a remote workforce. And I think many Australians can now just, move out of the city centers and the metro areas, and they can really move out into more sort of regional towns, and while still really maintaining the same income or the same jobs that they've had. So I think that's really benefited those property markets. And then another dynamic is obviously, record low rates, as you guys mentioned. It's made affordability even more affordable. It's cheaper to borrow. And then we've had unemployment stay quite low, which is really fueling this housing boom that we're seeing now. And then the last dynamic that we're seeing, I think it's a big dynamic. It's the border closures. The lack of net migration will eventually have an impact, I think, in the long term on the property market in Australia, if it continues to be the case. I think in the short term, what it has created is basically labor shortages, and especially in the building industry. It's created a backlog of new home being constructed, and residential apartment blocks and so on. And this means that supply is limited, which again is keeping prices quite elevated. So we sort of look more on the dynamics in the big picture. And so that's sort of the view that we're seeing.
Okay. And so in terms of the beneficiaries, then eventually our borders will open back up to foreign migration coming into Australia. Where do you see that impacting in the first instance, and where might the opportunities sit when that occurs?
Yeah, I think, in the long term, having a lack of net migration will impact. I think immediately, as I mentioned, opportunities are probably in those areas. We're seeing the sort of more suburban property markets or regional areas really booming because of this work from home phenomenon. I think the retail, if you look at retail property, they've probably been the biggest hit with this pandemic. I think the shift to e-commerce and online shopping has really shifted sort of the balance of power between landlords of retail properties and the tenants. And I think, probably retail and shopping center landlords will probably have to be more reasonable when it comes to charging rents in maybe potentially a new era of retail. And then obviously the office market. I mean, I know that there's been some comments on that. I still think that although as things open up, people will want to return to their offices, I don't think we might see the back to sort of 5 days a week in the office. I think it might be sort of 3 to 4 days as the new norm. And I think that will definitely have an impact on the office property rentals and the valuations at the end of the day. So, there'll be opportunities in all kinds of markets, and investors sort of need to look for those.
Okay, very true. They say the 4 most dangerous words in investment are "this time it's different." Troy, given the changes that we've seen and against the backdrop that we've been discussing today, has there been any change in the way in which you conduct your due diligence into a property investment, or perhaps the way that you might look to manage or exit it ongoing?
I think it's reinforced the approach that we've had. Our approach has been very much our approach at Aviator, we're looking at property with great fundamentals. It's got to have great tenant, great covenants, well located. It's got to be in a sector. We've got to understand the tenant's business. We've got to understand, and preferably if there's preferably diversity across multiple tenants. So all of that's kind of been core, but it really, I think it brings new focus now, where you're probably delving that little bit further into perhaps the economics or the future for the tenant's business. We like to look for, historically, we've looked for areas that are growing either through government infrastructure or areas where there are other activities that are taking place that are building value there. That's, I think, kept us in good stead with a number of our assets. But again, I think that's a little bit harder to predict now. So that makes it a bit more challenging as well, looking for where's the next growth story. As a couple of our panelists have said, inflation is a big issue, and over stimulus. I think that's a real problem. So how much is real growth? How much is lasting? How much is going to be here in a year or 2 years? How much is just wasted money? So I think there's a slightly deeper focus on some of those factors, but a lot of the and the other one I should say is obviously making sure with leases that you're not there's the opportunity there for this generally preferably net leases, fixed increases, things which are kind of inflationary hedges as such within your property portfolio. So yeah, that I think is we've changed. We're probably there's a tighter focus now on those things, but it's been a focus that's kind of been there, as an underlying factor pretty much from day one.
Okay. And so, Darren, perhaps you could share some insights from some of the things that your clients have been interested in, some of the areas of the property market they're looking for, and perhaps a deep dive into the process that you undertake before bringing one of these opportunities for fractional ownership through to your investors.
Yeah, we see, we're seeing mainly, a lot of demand across the eastern, the eastern cities, so Brisbane, Sydney, Melbourne, definitely. And, it's driven by also people looking for more, house and land opportunities, as well as just, the apartment sector as well, which has been interesting. And, as far as kind of how the properties come onto the platform. So, we're an agnostic platform, and it's up to the vendors to provide, the stock, and obviously we're driven by the demand of our clients. So, there's always, we always keep an eye on kind of what the clients are wanting and what they're kind of asking us for. There's definitely a lot of interest in more in that kind of traditional house and land kind of package. And also what's interesting at the moment is that people are looking for more high yielding properties as well. So there's a lot of interest in kind of the co-living kind of space, and also, things like NDIS and that disability sector. So there's a lot of opportunity around that. That high yielding. Also, what's interesting is there's also some appetite or growing appetite for more social investing as well. So not just that disability sector, but also in things like, in New South Wales, for example, you've got the affordable housing opportunity, where it's basically a 20% less rent. People are actually, looking to invest in those types of assets as well, more from a social point of view. Now, I don't know whether they've just had more time to think because they've had chill out time at home over COVID or what that is, but it's still quite interesting anyway. So we're definitely seeing a lot of demand for, right across the whole, remit of different properties.
And do you find any of the investors within your realm have a demand for perhaps a more contrarian approach to property? Perhaps, say, student accommodation, for example, at a lower entry point in anticipation of a reopening of the borders at some point in the next couple of years?
Yeah, absolutely. I think that's definitely a driver for it. I think that's, the student living, co-living kind of space is definitely one that's evolving quickly. And, it's the people that want to just get into that or have a portfolio. But, like the biggest challenge with, taking on those types of assets, I think is really around, which one do you choose? And so, allowing people to create a portfolio, really helps them diversify and take a wider approach to those types of assets. So it really starts to work. And we've got an event coming up in July, Corporate Nation, where we've got some of those big announcements around those types of properties and those types of opportunities, in Sydney. And we've got people like, realestate.com.au coming and talking to us about, or talking to the audience about these different opportunities and how innovation is changing the way that people are buying property now and the different access. So it's not just about the accessibility to, for people just to join the property ladder, but it's actually changing a lot of different ways around people, how people can access the different properties.
Okay, very true. And Jerome, we've discussed inflation a little bit on today's panel session. Could you give us a bit more deeper insight into where you're seeing inflation domestically and abroad? And do you think the Reserve Bank will blink? Is 2024 the magical line in the sand for interest rates here in Australia?
No, great question, Rob. I think it's a really relevant question for investors because, as outlined earlier, we've got asset markets which have really bought into the theme that policy is going to be easy forever. Interest rates are going to be zero forever, or effectively forever, in terms of their time horizon. And therefore, we can impute really high prices into assets, and we can accept low yields, and we can accept all four fundamentals and whatever, and just price things up regardless, because what else do you do with your cash? And look, we agree in the sense that, cash is trash, arguably, in this environment. But by chasing the same sort of risks, which is what most investors are doing, they're putting more money into shares, more money into property, they're leveraging up. We've seen this so many times throughout history, right? That people chase risk at the wrong times and they're exposed to the risk leverage and all the rest of it. Now the question mark is how long it goes on for before it stops, right? And that's the $1 million question. When do policy take a step back? Now, look, you've had people like Paul Tudor Jones come out recently and say, look, policy's batshit crazy. And a lot of us think it is, frankly. It's totally overdone. It's creating all sorts of distortions. It's created the inequality that you see in markets. At the end of the day, if your house price gets pushed up, it's actually not very good for anyone. Like I'd argue, it's actually not a good thing because you've got to live somewhere, and the children now can't afford to live anywhere. It doesn't actually serve much real purpose. I mean, what you want is an economy where money's being put to work productively, right? And if you create if you create a speculative economy, which is what we're doing, then you get all these sorts of distortions happening. And so coming back to the question, when does this stop? Well, look, we're already seeing tremendous inflationary pressure. So, I went to a car repair place the other day, and he's got these cars lined up along the street. Like, this is a guy that actually needs more property to park all the cars. Why? Because he can't actually bloody repair them, right? Because actually he can't get the parts. They're sitting there for months. The industry can't get the parts out of Asia or wherever. But which brand? He said all brands. Basically it doesn't matter. They can't find any parts to actually repair the cars. You try and get a builder now. The good builders are all gone until next year. They're all busy as hell. They're pushing up their prices. They can't find windows. They can't find the plastic, the things that go under to create the floors. They can't get the components they need to actually build these new properties either. So you've got supply constraints coming in because of COVID and because of a lot of people, going bust and all the rest of it. And you're just not able to meet this, and yet you're stimulating the hell out of the economy. So you've got this huge demand for these components. So you're getting real inflation. On the ground, you're getting real inflation. You talk to the companies, you listen to companies, they'll be telling you, we're seeing inflation everywhere, right, in the real world. And we're even seeing it now seep into the official figures, right? So, US, particularly the US, 5% inflation last month. Month on month was much higher than that. There's a big argument going on at the moment. Is it transitory? Is it permanent? And that's a critical question for markets, right? Are we going to see inflation persist, or is it going to die off as sort of COVID comes back and the stimulus gets removed a little bit? But they're in a bit of a quandary, policymakers. They're really scared shitless of this debt bubble that's being created. There's huge amounts of debt out there. And if they don't support markets, then they'll fall over under their own weight, basically. So they're in a bit of a pickle. Yet we know that if by supporting markets, overly supporting markets, excess stimulus, they'll push prices up too high and then creating these tremendous inflation pressures on the ground, which create all sorts of problems, right? Basically. And at the end of the day, we'll ultimately, in a normal world, will force up interest rates, right? Are we going to see it? No, that's the $1 million question. When are they going to buckle? When are we going to see a taper tantrum next? It could be quite soon. It could happen, right? They start talking about it. They're thinking about talking about it now. So, they're getting closer to the point where they start to do something to sort of indicate, well, maybe policy is a bit easy. And look, at the end of the day, what we know from lots of studies is that to sit forward and say, look, interest rates are going to be zero in 3 years' time. People have no idea what interest rates should be in 3 years' time. They really don't. We've shown throughout history that people can't pick interest rates beyond about 6 months forward. So, to sit here and say we know interest rates are going to be zero in 3 years, in 5 years, in 10 years' time, and therefore we should have, these huge prices that they're justified, that's a very, very brave call, basically. And it's not really supported by anything. It's just a belief that, policy will be easy for everyone. And because that's what, at the end of the day, it's just trend extrapolation. It's just people saying what we've had recently, we're going to continue to see. And I think that's a very brave call and a very dangerous call for investors to be overexposed to in their portfolios.
Okay. And Ron, what's the Tamim Asset Management house view here on inflation, and how do you see it playing out?
Yeah, there's definitely inflation. There's no doubt about that. I think historically, inflation is actually really good for property markets and other assets like commodities and equities. I think there's a few ways to play inflation. I mean, one thing you want to keep in mind at the moment, and I think just like Jerome said, we don't really know whether it's sort of more inflation is transitory because of these sort of supply shortages and shipping delays as a result of these shutdowns last year around the world, So, we're seeing in the construction industry, we're seeing construction costs really go up, and in all of the input that, materials that go into building a home, such as wood and steel and plumbing parts and so on, have gone up. So that's leading to inflations, and then those labor shortages, which I spoke about. Historically, if you look, the best sort of ways for investors to play against inflation has been to invest in gold and other commodities. Now, actually, they tend to perform really well in inflationary times, and actually, that's really played out pretty much. We've seen all commodities like copper, iron ore, lumber, and then agricultural commodities all really gone up in prices dramatically. Funnily enough, gold actually, is meant to perform the best against high inflation times. It actually has been really been an underperformer from all the commodities. Now, that's quite interesting, and maybe it's because of all these cryptocurrency and Bitcoin that has emerged, and maybe that's replacing gold as an inflation hedge. I don't really know, but funnily enough, gold really hasn't performed. I think my fund, we don't really invest in commodities, and the way we're playing against inflation is basically we're investing in equities, but we're trying to look for companies that are growing profitably, businesses that have products and services that will continue to have strong demand, and then we believe that these businesses can continue to raise prices with inflation, and that's sort of what we're doing at Tamim. So that's sort of our view on this matter.
Okay. And so, Ron, have you been tempted to invest into any AREITs, any listed Australian real estate investment trusts within your fund? And given they are listed entities, has there been, how much of this do you think could possibly already be factored into their share price?
Yeah, I mean, there were some opportunities, obviously, last year, and coming out of the March sort of the equity market meltdown. I mean, there were a lot of opportunities, and I think you could have pretty much bought anything to do with property and you've done well. I mean, we did like some of that sort of pubs and hospitality sector. We invested in a company like Red Cape, for example. They run pubs and they actually own the properties all over the east coast of Australia. We did buy some office trusts that we thought had really long-term, good, large sort of corporate tenants that paid a really nice yield. We don't really own any of these anymore. I mean, most of them have sort of, I think, have come back quite a bit towards their sort of net asset values. I'm not sure if those asset values today are the same as they were prior, based on all those dynamics that I spoke before, whether some of these, office valuations, for example, are the same as pre-COVID. But yeah, I mean, apart from that, there are some opportunities, and you got to nitpick and look at, at these companies, these businesses, or these REITs, and who are the tenants and the term of the leases and so on. And I think there's a few good opportunities there, and there's, some of them are paying like 8-9% yield, so it's pretty attractive.
Okay. And so on that yield point, Troy, at the coalface of managing landlord tenants and building in leases for the ongoing operation of properties, what trends are you seeing? Are you seeing that leases are being established more on a mark to inflation basis at renewal, or are you seeing there's more of a renewal based on market appraisal at the time? And how would landlords prudently manage their leasing strategies around it?
Sure. I think the thing to remember particularly with commercial property, is that a lot of these deals, when you get into them, particularly if you're doing a new deal, it's a 10-year horizon or a 12-year horizon. Businesses don't come up on a regular basis and sit there and say, I need to redeploy into new facilities, or we've changed the way that we're operating and therefore we're going to move. So what you find, what I'm sort of referenced that is, what you find is that the leases they don't tend to be highly reactive. They tend to be kind of, relatively staid. There's a way of doing things. You find that depending on, and a lot of leases sector by sector can vary. So, for example, if you're in bulky goods, you're in retail, those leases, generally it's hard to get a net lease signed. There's always been some element of gross lease, i.e., they want you to cover, certain costs. and they'll pay rent, but they're not. It's not a completely net structure. There are others where if you're in the industrial space, they quite often have been structured your 2.5% to 3% fixed. They're longer term, so that's where the real value is in. For example, if you look at an industrial lease and you sit there and say it's 6%, I looked at one very recently. It's a 6% yield. It was a 15-year fixed term. At the end of that, you're talking, within 5 years, you're talking about a compounded nearly, with debt in that, circa 15%. And you've still got 10 years left to run. So you've got to get into the micro on some of those things. There are other offices. You'll see, there's been a number of leases that were written, particularly CBD, things like that, where 4, sometimes 4.5% net increases were in the lease. They're great. I mean, that capitalizes very, very quickly. But again, what you get with one hand, you sometimes have to give away, because the higher the relative increases or the respective fixed increases, the more mark-to-market opportunities you want as a tenant. So, I mean, when you're dealing with big companies, big organisations, these guys are not silly. They understand how the mathematics of this works. And so, yes, you might do better on your fixed increases, but you will certainly see that there'll be an increased view to going to market. And that's sometimes not your friend. I mean, you can get cute, and play with things and say, all right, well, yes, we go to market, but there's a ratchet there. Again, most large companies are kind of aware of those types of structures, so you'll find that there's a resistance to that. But essentially, yes, the way leases are negotiated are still pretty much the same. That doesn't change. A lot of the provisions there are kind of almost hereditary. That's how long they've been there. And what I've sort of been trying to outline is that sectors and industries have their own view of how their leases should be structured, and they are quite different. So they're not that responsive. It's not that easy to change. The tenants have a view of what they want. So it is relatively fixed what you can ask for, but there are kind of little things that you can do to adjust on the journey.
Okay. And so do you see there being any particular threat to the yield on real estate assets moving forward, particularly given the potential inclination for state governments to increase land taxes and those types of things in response to their own budgetary pressures coming out of COVID?
I think Jerome gave a great summary of, economically where the situation is with cheap debt. I think cheap debt it's been a factor of, saving the economy or attempting to save the economy. I don't disagree. Arguably, it's been overdone. I think that's probably, pretty clear. The biggest impost, I think, the biggest risk we've got to a point now where for example, I remember chatting to my parents about their home loan, and it was 15%, and they said, it got to 17%, and you're going, okay, that's great. That's, that's a significant increase, 17%. But as a percentage increase, to shift from 15 to 17% is maybe, I won't do public maths, but, it's 12, a bit long, say 12%, something like that. If you go the other way, we're in a situation now, I think, where the entire sector's got a gun to its head, because you're at the risk of, trying to disentangle yourself. We've now got everyone re-gearing up at, 3s, 2.5s, now potentially 2s in terms of an interest rate. We've got the whole sector there. If that shifts back out, 2 goes to 2.5%, well, that's a 25% increase. That's almost untenable if you're fully geared. I mean, that will wipe players out. So there's this view of, that impost vis-a-vis potentially the impost of land tax, other sorts of things. Yes, you're seeing those go up, notably Victoria, where you've and you're seeing like a 2-speed land tax, where if you're a foreign resident, you're expected to pay significantly or dramatically more than what you pay if you're a local resident, those sorts of things. But while they're risks, and while, they're not that important in many respects, because a lot of that in most of the lease structures gets passed straight onto the tenants. The real risk on an ongoing basis is the cost of debt still. It's been the saviour of property. It's been the driver of the boom of property. It will be ultimately the demise of property. if that's not eased off gradually. I tend to agree that I think 2024 is a very, very bold prediction to say that we're going to keep interest rates at that level. We are, certainly at Aviator, all of our funds are sort of in that 8 to 10% yield range. We don't go in for lower yielding assets for exactly that reason, because the real, there are a number of large, it's my personal view, there are a number of large funds that are buying assets, particularly industrial assets, sub 4%, mid 4s to sub 4, particularly in Victoria. I think that's madness. And I just, because your exposure to the cost of debt, your ability to extricate yourself out of those types of positions if interest rates move up is very, very limited, because you've got very little to play with. If you see interest rates go to 2 or 3% and you've got assets that are yielding 3.5%, it's very difficult to make an attractive, make your fund attractive. Seek other reinvestment, particularly if you're publicly listed. So yeah, it's very, very fragile times, I think, for the sector.
Okay. And so changing tack slightly, Darren, what you're doing is very much at the frontier of technology and innovation in the property space. What do you see as being the next natural progression from there? Where can you see technology and innovation taking property investing over the next 3 to 5 years?
Yeah, I think the two main things that as an overall is really the efficiency of what the technology will provide. So being able to make it a bit easier to trade in and out of certain property assets, that's always a bit of a challenge. And as we're already starting to see that things like stamp duty, as those kind of different tax things change, we'll see the efficiency grow even more. So it's really around that kind of efficiency of being able to move things around a lot faster, being able to transact a lot faster. So for example, on the Bricklet platform, it's a really simple process to create a user ID, to then do the ID check, deposit funds, and buy Bricklet. So effectively you're buying property, right? So, and you're on title. So you can within a couple of days, you sign on as a user and you're now on the land title of the property. So very different to, the traditional method. So that definitely will change the way that that people transact with property. And, we'll see this more and more. And also the ability to create more substantial portfolios and diverse portfolios, not just across regions, but across asset types and across, I'll have some residential, some commercial, some industrial, all these types of things. Because it just makes the whole ecosystem more flexible.
Okay, very true. And Jerome, you've spoken previously about the need for many of your clients to diversify away from property, given some very overweight positions that they hold. Perhaps you could give us a little bit more detail about some of the top things that you're doing in your funds management business in order to provide that diversification and some of the benefits that exist there.
Yeah, so what we're interested in is if the Wealthlander and the Wealthlander Diversified Alternative Fund is providing an alternative, right? A diversified alternative basically to the traditional portfolios, which are basically, as we talked about, long property, long equities, long bonds, and it's all the same underlying risks since this exposure to interest rates at the moment, really. At a big picture level. And so, two things. I think the opportunities for investors are, how do you be more active? So you're not as dependent upon markets in order to produce a return. And you can do that across all asset classes. So even though we don't do property, I think if you were going to do property like this, like with our mentality, you'd be all about the value-adding opportunities, right? So how do you create value if prices aren't going to go up? That would be our focus if we were to do property, which we're not. And it's the same focus within other asset classes. So we say to ourselves, look, long-term equities are priced, to do 5 or 6%, say. And, if they're lucky, maybe, depending upon where you put interest rates at the end of it. And we go, well, look, for the volatility that you're exposed to and for the risks you're exposed to from property equities and the rest of it, if you're just getting the mainstream return, it's just not attractive. You're taking a lot of risk to get a low return, in our view. So, we've got to go deeper. And we've talked about, I think Troy's touched on that, the other speakers have touched on that. You can't just say, look, blanket, I'm going to buy everything, because everything's no longer good value, right? You have to look very selectively and find what's value and find what you can add value to. So we're interested in the active, looking deeper, researching deeper, finding selective opportunities that make sense, with the world that we see that's different, than a more challenging investment world. How do you create value for investors? So if you're investing in equity, You don't want a 6% return. You want a 15 or a 20 or 25% return. How do you get that? Well, you've obviously got to be choosing very well, right? You've actually got to be choosing very well. You've got to be more dynamic in terms of your trading of that opportunity within equities. We're interested in long short strategies, not just long only strategies. There's lots of stuff that's overpriced. Can you take advantage of that to hedge your portfolio? Can you cherry pick when to hedge the portfolio overall? Can you hedge out interest rate risk? All of these things is the sort of stuff we're looking at. We're looking at we're very interested in event-driven strategies at the moment. So how do you, something where we can see, look, 3 or 6 months' time, there's going to be some event that's going to crystallize value with this opportunity. So therefore and that's going to be the main driver of the return. It's not going to be whether something goes up or not. It's about whether this particular opportunity can be realized, and there's an opportunity to add value to that within that particular opportunity. So regardless of what the asset class does, we can make money. So that's the sort of thing we're interested in, alternative active strategies, creating a diversified portfolio of those, because I've been looking at strategies and rating fund managers and all the rest of it for a very long time, for about 25 years. And one thing I've learned is that you've really got to be picking the eyes out of stuff, right? You don't want the mainstream stuff. You want something special when you're buying stuff. And the other thing I've learned is that no matter what you think or how good you think something is, you want to be diversified, because you can always be wrong on any particular opportunity. And to put the odds maximally in your favour, you want a genuinely diversified portfolio. And a lot of people get this very wrong. So it's great to talk about diversification, one free lunch in finance. But at the moment, when there's certain things happening, you have to respond to what they are. A lot of people look at asset prices and they say, well, the last 50 or 100 years, it did this, so therefore it's going to continue to do that, without thinking about how different the starting point is. The starting point today is very different from what we've seen in the past. And therefore, what gets you diversification in the portfolio is also very, very different. So for us, it's more alternatives, it's more active strategies, it's less of the mainstream beta or less of the mainstream asset class return that you want. And it's been much more selected, much better researched, and really trying to pick the eyes out of stuff that's going to create, the 20% plus returns per annum for the next 5 years.
Okay. And Ron, do you have any final thoughts about the current state of play with markets? And what would be your top tips for investors doing their due diligence in this market to make the most of the opportunities that present themselves?
I think, look, there's going to be a lot of opportunities in 2021, like there's always been. I think when you're looking for certain companies to invest in, I think there's certain fundamentals that you want to look for as an investor. And, things that we look at, for example, you want a business that has good revenue visibility. You're looking for, a business that, has quite relatively high switching costs for its customers to switch out of it to a competitor. We're looking for preferably profitable, cash generating businesses. And, sometimes we're also willing to forego profits in the short term if a company is growing revenue really fast and taking market share quite quickly. And we're looking for businesses with strong balance sheets. And just generally, we like companies that are disrupting industries. And there's a lot of disruption happening at the moment. And just industries with strong tailwinds. And then finally, I think more importantly, especially if you're sort of investing outside the sort of top 50 stocks in Australia, I think you want to look at the management team, and you want a management team that you can trust, and you want a management team that has a long track record of success and execution. And, if we look at sort of opportunities this year, I think, we think equity markets will continue to perform well. Obviously, there will be volatility here and there, like always, but I think as long as rates are where they are, and I think they will stay where they are for now, I think equity markets will be good. And there's a few industries that we like. I think the payments industry, COVID has really made consumers avoid the use of cash and shopping online. And there's a lot of payments companies that are enabling this. There's a couple of stocks that we like, SmartPay, which is a merchant terminal provider in Australia and New Zealand, similar to Tyro. So businesses need these terminals. And then another one that we like is EML Payments. They're a global issuer of payment solutions, and I think they're going to do quite well. Another industry that I think presents opportunity is the domestic travel industry. And, I think international borders are going to continue to stay closed probably for another 12 months. And I think it's forcing us to use our cars more frequently, whether we're going for a holiday or whether we're commuting back and forth from work or picking up the kids from school or whatever. And that's driving a good demand in that industry. And, some of the companies that we like, for example, are, a consumer finance business called Money3. It provides finance for used and new vehicles. They're doing really well, strong demand. And then other ones that provide, the wheels and tires and mechanical repair shops to cars, such as National Tire and Wheels, and RPM Group is another one. And then finally, I think another industry that's doing really well and we like is education technology. I think that's an industry that, we've shown that, with the lockdowns, studying online is really important. And I think schools and other education providers globally have realized that, they got to have the capability to deliver online education. And that's really top of mind for them. And I think there's a company called Janison Education, and they're one of the global leaders in online assessments, and they're doing really well. So, that's the sort of opportunities and industries and trends that we're looking for, and the type of companies that we like to invest in.
Okay, thank you, Ron. And Ron, if anyone from our audience wanted to reach out and connect with you, how would they go about doing that?
tamim.com.au. You can go to our website, you can email us, you can call us, or you can come visit us at our offices in Bondi Junction.
All right, fantastic. Troy, did you have any final comments you'd like to share? And equally, if our audience wanted to reach out to you for more information or to get a deeper understanding of your perspective, how would they do that?
Sure. Look, I think, most of our panelists have echoed similar sentiments in terms of investments, which is there's opportunity there, but it's also, you've got to be cautious. I think there are, there's significant headwinds across, whole swathes of the economy. There are opportunities. There's people who have lost their capital. There are industries that need to be recapitalized. There'll be industries that are kind of, once they're recapitalized, be profitable again. There's a range of kind of opportunities that are going to come forward, but it is, I think, important to be conservative. It's important to construct your portfolio properly. It's important to be diversified, as Jerome has said, and it's important to, particularly if you're taking risks in assets, that you are not risking anything more than what you're prepared to lose, particularly with certainly some of the more high risk strategies. But having said that, certainly with a property specific focus, we're starting to see, and you see watching the real estate agents and what's coming out now, there's been a very, very quiet period, call it through COVID. You're now starting to see a lot of development portfolios. You're seeing a lot of development assets coming on the market. You're seeing people who can't hold assets anymore and are forced to sell. So there's opportunities there, but again, going back to what Jerome said, it's about picking the eyes out of it. It's not about, everything is not good. There's a reason that things are coming to market. Not everything has not every cloud has a silver lining in this, in this scenario. So it's important to keep an eye, important to be very strategic, very well researched. And again, if you wanted to hear more, wanted to sort of chat to us directly, www.avcap.com.au is our website, and you'll find all our contact details there, and be more than happy to engage with any of the audience that want to hear more about what we've had to say.
All right, fantastic. Okay, well, Jerome, then, perhaps if you have some final thoughts you can share.
Yeah, I think the good news
and how we can get in touch.
Yeah, the great. I totally agree with what Troy said. I think the great news is that there's lots of opportunities out there if you're prepared to dig and look hard enough and do your work. I think lots of investors lots of big investors in particular, haven't adapted their investment strategies for the new environment we're in. And post-COVID times are different from pre-COVID times. They're going to be different. What the government chooses to do is going to really matter across lots of things. There's lots of inefficiencies in markets. We're seeing huge numbers of opportunities, notwithstanding the fact that markets are very expensive for active managers, for active strategies, and to create a lot of value. And so I think there's a return, paradoxically, at the time when a lot of people are going to being more passive, like hands-off, lazy kind of investors. Everything should just go up. There's huge opportunity for the active investor that's looking underneath the surface in any asset class, really, including property, including others. And you want to be investing with the people who are actually doing that work, actually prepared to get in there, roll up their sleeves, and look under the cover and see what's worth investing in and what's not. And we consider ourselves one of those investors, and And I'm very welcome to speak further with anyone who's interested in learning more about what we do. Wealthlander.com.au. Love people to wholesale investors to subscribe to our newsletter and connect with us. That'd be terrific. And we'll be building the business for many years, like many of the other panelists, I imagine, and looking for investors. So.
Okay, fantastic. Look, we've had a fantastic conversation today. We've covered a lot of ground, from inflation to various sectors of the property market and technological innovation therein. And we've also had the opportunity to share some great insights and practical tips with our investors. I'd like to take this opportunity to thank each of our panelists for giving us their time today. And certainly, as they mentioned, for any in our audience who would like to reach out to them directly to learn more, please feel free to do so. Thanks again for joining us for the Wholesale Investor panel session on property investment and development in a post-pandemic environment. Thanks again.
Thanks, Rob.
Thank you. Thanks, Rob.
Thank you.
Thank you for joining us for our annual Property and Funds Virtual Investor Showcase. I also want to say a big thank you for our speakers, for our panelists, and for all the companies that participate in this event. The last 12 months has been a trialing period for most people. It's also been one where great opportunities are being created as well. And what I love about this space and what I love about the people that they work with is they seem to have that ability to take what is a challenge and then, as I mentioned, turn it into an exciting opportunity for investors. So from here, the next step is to go onto CRIISP, connect, network with the companies that are featured, set up meetings, have discussions, because really what this is all about, it's about bringing together ambition and it's about bringing together capital. And the only way we can do that is via engagement. So from here, as I said, go into the platform, request access to the deals which interest you from today's event, and then also add them on LinkedIn, and then let that connection process start. We look forward to seeing you at our next event.